Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, you hear about consumer sentiment a lot and whether or not that's an indication that the economy is doing well or the consumer is doing well. Well, we have another index, and when you look at how both of those are performing against each other, boy, is it eye-opening, and you do not want to miss this video. We're going to dive into what exactly is going on and why you need to be aware of what's happening. Let's dive in.
Trade Genius.
Hey buddy, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Just promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening.
Hey, Bob. So, every week or so we get the consumer sentiment from the University of Michigan, and sometimes that pops the market, sometimes that drops the market. And I think it seems like we've been stuck in a range here. And I think the market's kind of sensitive to how people feel about inflation as of late. But this other index, the misery index, is when you put that into the perspective of the consumer confidence and what's going on here with those two graphs, it's really eye-opening.
Yeah, and if you combine that with Biden's performance results, people are miserable and angry. And so what's really cool, if you put up the narrative first, is that we have a situation where, and we've been talking about this, the jobs that are being created now are either low-paying part-time garbage jobs. We know that because the Fed tax receipts are low, and we know that the part-time job ratio is skyrocketing, full-time jobs are falling. But another tell is when the only jobs that you can get are government jobs, and it's above 10%, it's a recession. I think we hit 25%, Phil, and it's screaming at you. So nobody's hiring other than the federal and state and local governments. And I think this is a problem. We'll show this chart here because this is another correlation that we've got. I don't know how many correlations have created alligators, jaws in this thing. I mean, we should be in the alligator business. I mean, it's just amazing. Constant. This is what happens when you have absolutely somebody stepping on the gas, in terms of trying to create a narrative that the people aren't buying. And it's one thing to say that, look, recession equals lower stock market. But the thing that I worry about even more than all that, Phil, is that when people's expectations and the narrative they're being fed is not being met, one thing is they're like, why is somebody else doing well and I'm not? That pisses people off. Or the other thing they found it is nobody's doing well and you're being lied to, which pisses people off. And I think we're in that situation where people are like, I don't know how everybody's doing so well. I'm not doing well right now. And as the data unfolds this year, people are going to realize, well, no, nobody was doing well and everybody's stressing. And I think it's the worst possible outcome for this administration. But more importantly, is everybody's going to get defensive all at the wrong time.
Yeah, and what's crazy about this too is just the rate of decline right now going on with the misery index. Now you did have something similar going into 2015 and 2016, and we came out of that without going into a recession and things like that. But we also didn't have the amount of other indicators that we have now nosediving, right? We have personal interest payments skyrocketing. We have the rate of change on the M2 plummeting. These are all things that weren't the case back in 2015, 2016. So this is just one more nail, I think, in the coffin of the economy, short term anyway. That's basically given us a big fat red flag of what to expect, I think, later in the year. So, unless there's just some resurgence in the economy and we start seeing full-time jobs coming back, because like you've really pounded on the fact that the jobs data is misleading, because what we're seeing with this data is that jobs by the government is overwhelming, but a lot of it's part-time job growth too that's in the data, and we're losing full-time job growth, and I think that's contributing to the misery factor. Now when we start losing all those part-time jobs, then you've really got nothing to be happy about, because there's nothing else to spin at that point, right? You can't spin anything other than the fact that now we have job losses, and then we're going to probably see initial claims spike quite a bit higher. So I was looking at initial claims and the graph on that yesterday. You can't really make a case for data-driven recession, right? Or data-defined recession here. We just know that, talking to a lot of people, that it's probably amongst us already. But as that data comes in, and true, there's a lag on that, I think, once that initial claim starts to crank back up and the rate of change on that gets steep, I think then there's nothing that you can do at that point other than deny reality, because I think everything's going to start to roll over at that point.
Look, if bank credit's going negative and you're a debt-based system, I don't know how you grow.
Correct.
I mean, it's as simple as that. I don't know how you grow.
Correct.
And so eventually, cash flow will matter again, and we're at nosebleed level. So if you want to be long this thing, if you want to believe the narrative that historically when this happens, that happens, then God love you. But I think it's smart to be defensive here, because I don't know how an economy that requires ever increasing amount of debt is not getting new debt, and the government is not overwhelming the M2 falling. So that's the other thing too. I think M2 is falling faster than the debt is rising. So I mean, this is a perfect storm, and I think people need to be really, really cognizant of the fact. Look, the consumers tapped out. This is the classic push from the string, and the only mechanism that the Fed has at this point is to provide relief through dropping interest rates back down to zero. But just like the RRP, you can only go so far in these things before you blow things up. And we know from history, Phil, that when you start reducing interest rates, it's counterintuitive. Just like we told people, once the Bitcoin ETF comes out, Bitcoin's going to fall. How many people mocked us on that? What's it down 20% since then?
Mm-hmm.
So people need to just understand that everything that has a point in time in the future is already been front run.
Mm-hmm.
And you're the sucker that provides the liquidity if you bet that good news, because the good news has already been bought.
Yeah, and I think any investment here or trade to the long side, you have to look at it as a short-term thing. And what you're betting on is the lag effect going on right now between the last of the surge up in the markets versus the drag that the economy will eventually have on these markets, right? So you have that lag, and that's really what you're betting on, is that lag to continue. It's not betting on the economy, because every data point you look at is in contraction mode now, except for jobs, and jobs is not a forecaster. Jobs is a confirmation data point. So that's just the last thing that we need to see before, undeniably we're in recession. So anyway, guys, let us know what you think about this, and let us know your thoughts on how you view the economy going forward into the next few months. Other than that, thanks for watching. Please hit like and subscribe. And if you're interested in what we have over at our site, check out tradegenius.co. We'll help you navigate these markets, and you can get into the room with us and other traders. Thanks, guys. We'll see you on the next video. Take care.
Trade Genius.